With all of the negative news around commercial real estate lately, a lot of investors feel like there's not much to be excited about as we head into what looks like it's going to be a pretty difficult year for a lot of this industry. But while the huge run-up in interest rates has caused values to drop and transaction activity to slow significantly across the board, these changes have also had some pretty big benefits for the market overall that aren't being talked about as much as they should be. So to highlight some of these changes that are actually good news for commercial real estate investors, in this video, I want to talk through 3 of the biggest benefits of the shifts that we've seen in the commercial real estate markets over the last 18 months and how each of these things might continue to play out within the new year. So the first thing that I'm starting to see is that for the first time in really about 3 to 4 years, cash-on-cash returns on many commercial real estate deals are finally starting to look attractive. Because debt was so cheap up through the beginning of 2022, cap rates on commercial real estate also dropped to record lows at the same time, and together this led to very small or even non-existent going-in cash flow yields being the standard expectation on most new acquisitions. If you were buying a multifamily or industrial property in the middle of 2021, you would have most likely been buying that deal at a cap rate between about 3.5% and 4.5%, depending on the market, and also financing that deal at an interest rate between about 3 and 4%, depending on loan terms. And if you buy a property at a 4% going in cap rate and you finance that deal at a 65% LTV ratio and your interest rate on that loan is 3.5%, your going in cash on cash return in an interest only scenario would come out to just 4.9%. And if principal and interest payments were to be made each month using a 30-year amortization schedule, your going in cash on cash would be just 1.4%. But in many markets today, as interest rates have risen by over 300 basis points since the middle of 2021, cap rates have also expanded a full 150 to 250 basis points or more in many cases, which has provided some real opportunities for investors to generate materially higher cash-on-cash returns. And today, if an investor were to buy a property at a 6.5% cap rate and finance that deal with just a 55% LTV loan at a 6% interest rate, in this scenario, the cash-on-cash return would jump all the way up to 7.1% in an interest-only scenario and 5.7% in the amortizing loan scenario. And while these numbers might not seem all that significant as percentage values, if you're an investor that's trying to live off of your portfolio and you need to generate $100,000 per year to make that happen, this represents a massive difference to the total amount of capital that you need to accumulate. In the interest-only scenarios, you'd go from needing a little over $2 million in 2021 to just over $1.4 million in 2023. And in the amortizing loan scenario, you'd go from needing over $7 million just 2 years ago to less than $1.8 million at the end of this year. And this is really positive news for investors that aren't trying to hit home runs and just want to use real estate as a stable, tax-efficient investment vehicle that can generate cash flow. And the changes that we've seen in the market this year are making significant improvements for these types of individuals. Now, the second thing that I see is a major plus for investors right now, especially those that are looking at deals in markets with strong underlying demand drivers, is that the cost of debt is making ground-up development projects really tough to pencil right now, which has caused construction starts to drop considerably throughout the industry. The multifamily and industrial sectors are seeing huge inflows of new supply coming to the market right now, but the vast majority of these deliveries are scheduled for the rest of this year and into 2024. And with the way things stand today, there's projected to be a significant decrease in completions starting in 2025. According to Yardi Matrix data, almost 500 million square feet of industrial product was delivered in 2022, which was almost double the square footage delivered just 5 years earlier, and industrial deliveries are expected to remain high throughout the rest of this year and into 2024 at about 475 million square feet in 2023 in total, and about 470 million square feet projected to come online in 2024. However, in 2025, new supply is projected to drop by about 16%, down to just 400 million square feet, and new deliveries are expected to continue at that pace throughout 2026, down about 16% from 2024 levels. And for the multifamily sector, supply is scheduled to peak in 2024 with just over 536,000 units planned to be delivered next year, but from there, supply is projected to drop by almost 16% to 451,000 units in 2025 and expected to drop another 16% in 2026 to just 377,000 multifamily units delivered in that year. And with retail construction completions having been on a downward trend overall since 2013, retail leasing availability is at its lowest levels we've seen in more than 10 years, and construction starts for office properties fell by 8% quarter over quarter and 25% year over year in Q3 of 2023, with a combination of a huge uptick in rates and a significant drop in demand, giving developers pause when considering starting new projects. Ultimately, if we do slip into some sort of a recession in 2024 and the Fed actually starts to cut interest rates to stimulate economic growth, we could start to see a very big uptick in demand for a lot of real estate product types at the same time that supply growth is declining substantially. Now, the last big opportunity that I want to mention in this video is that even though there will very likely be a significant amount of distress across multiple product types in 2024, a lot of these issues will almost exclusively be the result of how these properties were initially financed. Aside from a lot of the office sector, which has its own unique set of challenges right now, operations have been relatively strong for retail, industrial, and many multifamily assets, with national vacancy levels sitting at just 4.8%, 4.2%, and 5.1% respectively. And even though operating expenses have increased for many property owners over the last few years, especially for things like labor and material costs tied to inflation and insurance premiums that have risen due to recent natural disasters, a lot of these increases have very likely already peaked, giving investors a lot more visibility today into what net operating incomes are likely to be on a property going forward. And instead of issues with operations themselves, aside from what we might see in the office sector, the vast majority of the distress we're likely to see next year will primarily be among properties that may actually be seeing flat or even moderate NOI growth year over year, but were just financed at extremely high leverage levels with floating rate debt and acquired at a basis that was reliant on double-digit annual percentage rent growth just to make the deal pencil. And if investors can pick up a deal in the next 3 to 6 months at a cap rate that might be 200 to 300 basis points higher than it might have been 18 months ago using fresh fixed rate debt with equity partners that are willing and able to hold on for the long term, this may actually be the best opportunity we've seen in the last 10 plus years to buy well-located assets with strong underlying fundamentals, potentially at a discount. Even though the overall sentiment right now is definitely not positive in commercial real estate, and most investors have come to the realization that 2024 is very likely not going to be easy, there's also a lot of potential upside associated with these changes in the market. And whether you're an industry professional trying to take the next step in your career, or you're just looking to build your own real estate portfolio, I see a lot of things worth looking forward to heading into the new year. And if you want to learn more about the real estate investment analysis process and how to build out models from scratch in Excel to underwrite acquisition and development opportunities, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on the current state of the market, make sure to hit the like button and let me know. And let me know in the comments when you think the best time to buy commercial real estate is ultimately going to be. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.